February 13th, 2026, 11:47 a.m. Eastern Standard Time. I'm staring at the screen, watching what looks less like a correction and more like an execution. Silver didn't drift lower, it didn't consolidate, it didn't cool off. It dropped vertically, from $84 to $76 in barely an hour. That's a 10% move in one of the most liquid commodity markets in the world. And within minutes, the financial media had their explanation ready. Strong jobs report crushes precious metals. Clean, simple, digestible. But the timestamps don't line up. Silver opened at $84.20. Overnight action was stable, even slightly bullish, after the Shanghai Futures Exchange reported another 4% drawdown in registered silver inventories. Physical supply was tightening. That should have supported price. At 8:30 a.m., the U.S. Bureau of Labor Statistics released the January employment report. 130,000 jobs added. Unemployment ticked down to 3.9%. Wage growth moderating at 3.8% year over year. Silver dipped about $2 in the first few minutes. That's normal. Stronger labor data can reduce expectations of rate cuts, which pressures metals. But what happened next wasn't normal. At exactly 9:14 a.m., a Bloomberg terminal alert hit. Sources: Russia considering partial reversal of dollar ban for select energy trades. 13 words. That's all it took. Within minutes, heavy sell programs hit the silver futures market. Not scattered retail selling, not random volume, structured blocks, 500 contracts, 1,000 contracts, layered beneath the bid. In the first 15 minutes after the headline, approximately 47,000 futures contracts were dumped. Each silver futures contract represents 5,000 ounces. That's 235 million ounces of paper silver traded in under 15 minutes. For context, global annual mining production is roughly 830 million ounces. So in a quarter of an hour, the paper market traded the equivalent of nearly 28% of global yearly output. Not physical bars moving vault to vault, not sovereign transfers, paper. And paper sets the spot price. The order book told the story. Sell walls were stacked just below market price, intentionally triggering stop-loss levels. Once $82 broke, automated liquidation programs accelerated. At $81.50, more stops triggered. By $79, it was a cascade. This wasn't emotional trading, it was mechanical, a liquidity vacuum created on purpose. By 10:15 a.m., silver printed $76. And then something interesting happened. The selling stopped. Not gradually, not slowly fading. It stopped almost instantly, and large buy orders began appearing. 800 contracts at $76.20, 1,200 contracts at $76.50. Aggressive bids absorbing everything. By 11 a.m., silver had rebounded towards $78. That's not how panic behaves. Organic selloffs are chaotic. They retest lows, they grind lower, they whipsaw. This looked like a controlled demolition, followed by controlled accumulation. Someone pushed it down, and someone was ready to buy the bottom. The question isn't whether silver fell. The question is whether the jobs report really caused it. Because if that were true, you'd expect broader confirmation across markets. But the 10-year Treasury yield barely moved. The dollar index rose modestly. Equities barely reacted. Only precious metals were violently hit. Gold dropped. Silver collapsed. Mining equities were crushed even harder. That concentration matters. Because when a single sector reacts disproportionately to a narrative event, especially one delivered via anonymous sources, you have to ask, was this a macro reaction or was this a trigger? And that's where the Russia headline becomes far more important than the jobs report. Because since 2022, the entire bullish thesis for gold and silver has revolved around one word: de-dollarization. And if that thesis gets shaken, even temporarily, metals feel it immediately. We break down why that 13-word headline had nuclear impact, and why algorithms may have been the real executioners. To understand why 13 words erase 10% of silver's value, you have to understand the foundation of this bull market. Since 2022, precious metals have not been trading primarily on inflation, not on recession fears, not even on central bank rate policy. They've been trading on confidence, specifically confidence in the US dollar. After sanctions were weaponized during the Ukraine conflict, something changed in global finance. Russia demanded energy payments in rubles. China expanded yuan-based trade settlement. Saudi Arabia signaled flexibility around dollar-only oil pricing. BRICS nations began openly discussing alternative settlement systems. The signal to global markets was simple: the dollar might not remain unchallenged forever. That perception shift fueled capital flows into hard assets. Gold rose from roughly $1,900 in early 2022 to over $3,400 by January 2026. Silver climbed from $24 to $84. Those aren't normal commodity cycles. Those are monetary repricing events. When investors begin to question reserve currency dominance, they move into assets outside the banking system. So when Bloomberg pushes a headline suggesting Russia may partially reverse its dollar ban for energy trades, it strikes directly at that thesis. It implies stabilization. It implies compromise. It implies the dollar system is reasserting itself. And markets don't wait for confirmation. They react to probability shifts. Here's where the mechanics matter. Roughly 70+% of futures volume today is driven by algorithmic trading systems. These aren't humans debating geopolitics. These are models trained to scan headlines in real time, assign sentiment weight, and execute within milliseconds. Keywords like Russia, dollar, reversal, energy trigger probability recalculations. If de-dollarization probability decreases, safe haven demand assumptions weaken, and silver futures get sold automatically. That's what likely happened at 9:14 a.m. Not a human conspiracy meeting, not a secret phone call, a sentiment shift interpreted by machines. But here's what makes the move suspiciously concentrated. If this were truly a macro shift back toward dollar strength, you would expect Treasury yields to spike meaningfully, the US dollar index to surge aggressively, equities to rally strongly. Instead, the 10-year yield barely moved. The dollar index rose modestly. The S&P 500 barely reacted. Only metals were crushed. Gold dropped over 3%. Silver dropped 10%. Mining equities fell even harder. That kind of sector isolation suggests something else, a targeted unwind of positioning in one specific asset class. And positioning was heavy. Silver had been consolidating just below $85 for 2 months, a classic bull flag pattern, tight range, decreasing volatility, coiling under resistance. If price had broken above $85, momentum algorithms would have triggered aggressive long positioning. Options gamma exposure would have accelerated. Shorts would have faced pressure. Instead, the pattern was broken downward. Bull flag invalidated. Momentum reset. Now let's talk about the jobs report itself. The headline was 130,000 jobs added, but the composition matters. 89,000 in healthcare and social assistance, 23,000 in leisure and hospitality. Manufacturing barely positive. Construction negative. Retail negative. The household survey actually showed employment declining. That's not a booming economy. That's a mixed labor market being framed as strong. Yet metals were blamed, which is convenient because it provides narrative cover. The public explanation becomes strong economy reduces need for safe havens. But the timing suggests the Russia headline was the real trigger. And that brings us to the structural layer beneath all of this. Because silver isn't just a commodity, it's a leverage structure sitting on top of a much smaller pool of physical metal. And that's where the real fragility lives. We break down the paper to physical imbalance and why futures markets can drive prices far away from physical reality. If you really want to understand why silver can fall 10% in under an hour, you have to understand one uncomfortable truth. The silver price is not set by physical silver. It's set by futures contracts, and futures are paper. The benchmark price for global silver is largely derived from trading on the COMEX, which is operated by the CME Group. Each standard silver futures contract represents 5,000 ounces of metal. But here's the key. The overwhelming majority of those contracts are never settled with physical delivery. They are opened, traded, and closed for cash, which means price discovery happens in a leveraged arena, not a physical one. Now let's look at scale. On an average active day, hundreds of thousands of silver contracts can trade. That represents billions of ounces in paper silver. Yet the total registered physical silver inventory inside COMEX vaults often sits at a fraction of that. At times, the paper-to-physical ratio has exceeded 100 to 1. That means for every ounce available for delivery, there may be 100 ounces represented in contracts. So when 47,000 contracts hit the market in 15 minutes, representing 235 million ounces, that metal does not exist in trucks, vaults, or refineries waiting to move. It exists as leveraged exposure, and leveraged exposure moves price fast. Here's how a cascade happens. Large sell orders hit the bid. Price drops below technical support. Stop-loss orders trigger automatically. Margin requirements spike as volatility increases. Over-leveraged longs are forced to liquidate. More selling hits. Algorithms detect momentum and join the move. That's not organic supply meeting demand. That's a feedback loop, a mechanical liquidation spiral. And because silver is smaller and more volatile than gold, it moves harder. Now add one more layer. Silver isn't just a monetary metal. It's also an industrial metal. It's critical for solar panels, EV components, electronics, medical devices. Industrial demand has been rising for years, especially from renewable energy expansion. So physically, the market has been tight. Shanghai inventories have been declining, refiners have reported higher premiums on physical bars, retail coin premiums have periodically spiked, yet futures prices can still collapse. Why? Because futures don't require the seller to own the metal up front. They require margin. And margin is far smaller than full notional value, which means you can sell enormous amounts of silver with relatively small capital. That leverage cuts both ways. It accelerates rallies, and it accelerates crashes. Now here's the most important observation from the February 12th drop. When price hit $76, physical dealers did not report panic selling. In fact, some reported increased buying. That divergence matters. Because if futures dump but physical demand strengthens, it suggests a disconnect. Paper price weak, physical interest firm. And historically, when that gap widens too far, one of two things happens. Either physical demand cools, or futures price snaps back violently. Which brings us to the final question. Was this event the beginning of a trend reversal, or was it a positioning reset before the next leg higher? We zoom out to the macro structure, rate policy, debt dynamics, and why silver's long-term thesis may not have changed at all. Now we zoom out, because a 10% drop feels dramatic in the moment, but context determines whether it's a collapse or a reset. Let's start with interest rates. For silver to enter a true long-term bear market, you typically need one of three things: sustained high real interest rates, a structurally strengthening US dollar, falling industrial demand. As of now, none of those are firmly in place. Real rates remain historically volatile. Inflation has cooled from peak levels, but it hasn't disappeared. If anything, services inflation remains sticky. That limits how aggressively central banks can maintain tight policy without pressuring growth. Second, the dollar. Yes, it remains dominant. But dominance doesn't require collapse to weaken. It only requires gradual diversification. Even small percentage shifts in global reserves can meaningfully impact flows into alternative assets over time. And third, industrial demand. Silver demand tied to solar production, EV infrastructure, and electronics manufacturing hasn't structurally declined. If anything, energy transition policy globally continues to support medium-term industrial usage. So if the macro pillars haven't decisively flipped bearish, what was February 12th? Positioning. Markets are forward-looking discount machines. When an asset runs from $24 to $84 in 4 years, leverage builds. Funds pile in. Momentum traders stack exposure. Options positioning becomes crowded. Sentiment gets one-sided. And crowded trades don't unwind politely. They reset violently. Technically speaking, the drop below $80 broke a multi-month consolidation structure. That forces systematic funds, trend followers, CTAs, volatility targeting strategies to reduce exposure. It doesn't mean the long-term thesis is dead. It means the positioning was too heavy. Now here's something important. After the flush to $76, silver did not continue collapsing. It stabilized. Buy programs stepped in, volatility cooled. That behavior looks more like forced liquidation exhaustion than fresh macro fear. And historically, forced liquidations create opportunity, not endings. But here's the caution. If silver fails to reclaim the $80 to $82 zone quickly, technical damage could attract additional sellers. Momentum works both ways. A prolonged drift lower would change the psychology. The key difference between a reset and a reversal is follow-through. Resets snap hard, then base. Reversals grind lower and make lower highs. The next few weeks will matter more than the initial drop, because dramatic headlines move price fast, but structure determines trend. So what actually happened on February 12th? A strong jobs report provided cover. A Russia headline triggered algorithms. Heavy futures selling cascaded through leverage. Stops fired. Margin calls hit. Price overshot. Then buyers absorbed it. Not a conspiracy, not a collapse of the monetary system, but not entirely normal either. It was a reminder of how modern markets function. Narrative, algorithm, liquidity vacuum, forced liquidation, stabilization. If you understand that chain, you don't panic when volatility spikes. You analyze structure. And silver right now sits at a crossroads. Was this the execution of a bull market, or the cleansing before its next leg? That answer won't come from headlines. It will come from price behavior, and structure never lies.